Regular investors lost more than $5 billion on options investing during the pandemic, and a lot of that was on hidden fees that you didn't even see. In this video, I'll reveal that $5 billion options investing mistake and 3 others investors make. I'll show you how to invest in options the right way and share an option strategy I use to get stocks at a discount. Hey Bowtie Nation, Joseph Hogue here, and options investing exploded during the pandemic. The ability to get that leveraged bets on top of the huge returns on meme stocks like GameStop and AMC was just too good to be true. According to the Options Clearing Council, retail investors traded more than 23 million call options in 1 week alone last year, and total daily options volume more than doubled from just a few years ago. Now think about it, shares of GameStop surged 155% in just 2 weeks last March, but the call options at the $150 strike price surged 1,000%, multiplying your money by 10 times. But that return and the options investing riches isn't what ended up happening. Research from the London School of Business studied options investment by retail investors between November 2019 to June 2021 and found the group lost $1.14 billion on total trades and an additional $4.13 billion in hidden trading costs. The table on the left here is option trades by non-institutional investors, showing the top and the bottom 10 in cumulative profits on those option contracts. And what is really amazing here is that even those top 10 stocks that produce the positive returns on the options investments, factoring in the trading costs means that investors still lost money in 5 of those best 10 stocks. But worse yet here is that the S&P 500 surged 40% during this period, meaning not only did investors lose money trading options, but they lost the chance to make a lot of money just investing in stocks. I'll reveal those biggest options investing mistakes next, but before we get started, you know I've got to send that special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. The first mistake options investors are making here, and this was a big one for losses, was buying out of the money calls days or even hours before expiration. Now I'll cover some options investing basics here, but look for the link in the video description below to a full video explaining options investing, all the basics and everything you need to get started, including my 5 favorite strategies. What happened though is options investors were buying these call options on hot meme stocks like GameStop and AMC. Those call options give the investor a chance to lock in a certain price for the shares until a certain date, that expiration date for the options. So like we saw in that example earlier, the call options locking in that $150 share price for GameStop surged from about $5 each to $60 in the space of just 2 weeks when that stock took off this year. Those options don't expire till June 17th, but you can buy options that expire in as little as a week. Those shorter term options can rise and fall even faster, and if the stock price isn't close to that locked in price, then they can trade for just pennies on the dollar. And investors got dollar signs in their eyes. They bet thousands of dollars on options contracts expiring within days that the share price would jump, and when it didn't, those options contracts expired worthless. Because that's how options investing works. It's not an investment you can hold forever and just wait for the price to move higher. Options have a finite life, expiring in weeks or months in most cases. You see here the options for GameStop, some expiring in a few weeks and one here out to next January. If the stock price doesn't move above that locked-in price for the call options, then the option expires worthless and you lose the money. Now, the solution here isn't necessarily just to avoid those option contracts expiring within a few days or weeks, but if you are buying those short-term options, you have better have a very good reason to believe the shares will get there. Basically, what do you know that the market doesn't? Because remember, those options premiums are already going to build in that known information. There has to be some kind of surprise catalyst to take the shares beyond that. Now, in fact, a lot of times, even if you think there's a short-term catalyst to send a stock higher or lower, you're still going to get an amazing return investing in one of the longer-term options. Say instead of buying those call options that expire next week, you buy the ones with a few months left. Now remember, those June call options on GameStop had 3 months to go and still jumped tenfold when that price took off back in March. Buying those longer dated options just gives you more time for that upside price to come true and still make a lot of money. We've still got 2 more options investing mistakes next, but I also want to personally invite you to get the Weekly Bowtie, our free weekly newsletter with all the stock market news, strategies, and trends you need to know. Each week before the market opens, I'll show you what I'm watching and the stocks that could highlight the week. It's all totally free, just something I like to do for all you out there in the community, so look for the sign up link below. The biggest mistake by options investors, the one that caused over $4 billion in losses, was not understanding the bid-ask spreads. Now, the bid and the ask prices for a stock are just the prices that someone is currently offering to buy the stock. That's the bid price. And someone is offering to sell the stock. That's the ask price. And you can see the bid-ask prices for shares of GameStop here. And for most stocks, the difference in that spread is only a few pennies and isn't much compared to the stock price. For example, that spread of 22 cents a share on GameStop is less than 0.2% of the stock's value. But now that difference in the bid and ask prices is magnified in options investing. Here we see the June call options on GameStop with a difference of $1.70 between what someone is willing to buy and the price another investor wants to pay. That's nearly 20% of the option value. So what happens is options investors, not understanding this, maybe just placing a market order to buy those options, would end up paying a huge premium on that option's value. You could be immediately out 20% on your investment. And the investing apps like Robinhood weren't about to warn their investors. The researchers found that payment for order flow, how Robinhood makes money by giving your trades to hedge funds like Citadel Securities to trade, payment for order flow surged for options trading to nearly $250 million a month last year, double what the platforms were making on those stock trades. There was big money on options trading during the pandemic, not on the options themselves, but on your trading. The solution to this bid-ask nightmare is to always use a limit order when you buy or sell options. This means changing the order type from a market order to a limit order. That allows you to set the price at which you're willing to buy or sell those options. Now you can set this somewhere in between that bid-ask spread or wherever you like, but it guarantees you pay that price. Now understand, setting that limit order doesn't guarantee that you're going to get that order fulfilled. If you set a price way outside what other investors are willing to meet, so far outside that bid and the ask spread, then your order might just sit there. But generally, if you do set a limit price close to where the market is, you can get a better price and not have to pay these giant spreads for your options investments. The third mistake here in options trading, before I reveal that options investing strategy that I use, that investors are only using these for speculation and ignoring the opportunities in options to lower your risk. Now, can options investing magnify your returns? Of course they can. Look at these call options on shares of BP after the earnings report. Just an 8% bump in the share price caused the option value to surge over 100%. But with that kind of return potential also comes the risk, and we've seen how that risk can cost investors billions of dollars. The real power in options, though, is they can actually be used to lower the risk in your investments. There are strategies like the covered call that are going to allow you to collect money on your investments, others that can turn a non-dividend paying stock into an income machine, and still others that allow you to limit your losses on those moonshot investments. I want to get into that option strategy, but I'll link to a few videos in the description below that go into more detail on these option strategies that I love. I'll share that options investing strategy next, but I want to get your experience on this as well. What option strategies have you used and which do you want to know about? Let me know in the comments below, which options trading strategies do you want to hear? One of the best option strategies, one that can get you a discount on any stock you want to buy, is called the cash secured put. But I've got a twist that is going to save you even more money. Now, the basic cash secured put is where you sell put options on a stock. And this means you're telling another investor that if the share price falls below a set price from now until the expiration date, then you're going to buy the shares for that price. For example, here we see the January 2023 put options for GameStop on the right side of the table. We see that we can sell the put options with a $130 strike price, with the option recently trading for $47.80 each. And that means another investor is going to pay us almost $48 a share right now for the right to sell us his shares of GameStop for $130 from now until next January, or about 8 months. And buying shares of GameStop for $130 might sound crazy if they're trading for about $118 right now, but look at what's happening. We're collecting almost $48 a share right now. Even if that investor immediately sold us his shares for $130, then we're really only paying $82.20 each because we collected that money. We're actually getting a 31% discount to the current share price. And there's really two outcomes here. If the share price is below that $130 strike price by options expiration in January, we're going to buy that stock for that amount and keep the $48 premium. As long as the shares aren't lower than $82 each, then we've made money. And the other outcome here is if the share price is above the $130 by options expiration, then nothing happens. The investor wouldn't sell us his stock for $130 if he could sell it for more in the market. So we keep the $48 premium without doing anything. Now, the twist on this is when a stock plunges like we've seen so many stocks do over the last few months. Because option prices are set on that volatility in a stock, how much it tends to rise and fall, you can get some amazing options premiums just after these big moves. For example, when shares of Teladoc Health crashed 48% to a low of $29 each on its earnings report, the price of the put option skyrocketed more than threefold. You could have sold these put options with a $40 strike price for as much as $15 each. And think about that. You could have collected $15 and committed to buy the shares through January for $40 each. So your actual cost would be no more than $25 per share. That's a 14% discount to where the stock was trading. Less than a week later, and the shares were already back up to $38 each, just $2 below that put price. If the stock closes above that $40 through options expiration in January, you keep the $15 and didn't have to do anything. Even if the shares close below that $40 each and you buy at that strike price, your cost is just $25 a share. Click on the video to the right for a complete guide on options investing, the basics, and my 5 favorite strategies. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.